All right, so let's begin. Insurance and investments are two things that people focus on their earlier years, but after retirement, both tend to take a back seat. On the Money Show today, we will analyze how you can plan your investments and insurance post-retirement. So for that, let's welcome on board Harsh Roongta, founder, Fee Only Investment Advisors LLP. Harsh, good evening and welcome to the show. So we all know the importance of retirement planning, and we all know why it needs to be the first financial goal whenever you start your investment journey. A lot of time, people tend to organize and think about the requirement or the financial needs that they might have after retirement. But what usually people miss out is to understand the requirement of insurance coverage, and the type of insurance coverage. Although insurance is something that needs to be in continuity, obviously it's not just post-retirement that you will think about having an insurance cover. It needs to be there lifelong with you. But talking about that stage when you are retired, what goes into planning, which could be an essential planning for your insurance post-retirement? How can you draw a structure for that?
So I think your insurance needs continue, but the type of insurance you need obviously changes. What is the thing that happens on retirement? Your income stops. So I think any insurance that you had to protect the continuity of such income is no longer needed. So you don't need, for example, term insurance, except in the case of, let's say, pension. So we'll keep that out. But you don't normally need term insurance for that. You don't need probably critical illness or accidental disability, because they were there to protect continuity of income. What obviously you continue to need is insurance that will pay the costs of any hospitalization or the costs of any illness other than hospitalization also. And that is very, very essential as you age, because as you age, and given modern technology, what is happening is that our lifespans are increasing, but because we are living longer and longer, the last decade of your life, or even earlier than that, is normally spent, with lots of health problems, which in turn has lots of costs attached, which you have to plan through an appropriate health insurance. And I think the key there is that most people think they will do it once they retire. So let's take the case of a person who's working in an employer, and the employer has given health insurance which they find, say, adequate. So they don't even bother कि retirement के बाद देखा जाएगा. But as you age, you already get some diseases, maybe diabetes, maybe blood pressure, maybe something much more. Please remember, as you age, even if you are super fit, your ability to get new health insurance is very limited. One. Second, even if you do get it, it will come at a very, very high cost, but getting it itself is a problem. So, and plus, typically all of them have waiting periods before certain diseases will be covered. So I think building your own health insurance outside of what your employer gives you is critical. This is something that you ought to have done at least 8-10 years before, so that minimum 8 years of no claim history is there, so that a claim cannot be denied to you post retirement. Another thing that a lot of people don't know is that when you retire, the employer insurance, the employer group insurance that exists, the insurer is required on your request to give it to you as a regular individual health policy or a family floater health policy on the same terms as what they give it to in the outside world. The big thing is they're required to give it, one. And two, you carry your claim history with you, which means that any waiting periods would have deemed to have been completed. And if you have been in that job for 8 years, then you would have that. Now you would have an individual health policy for which you will need to pay from your pocket, but at least the claim process on that will be much easier because the 8-year history would have been completed. So, to summarize, don't put off health insurance till the last. Make sure you have your own health insurance. Be aware that you can convert your employer's group insurance policy into a policy owned by yourself, including in some cases your aged parents. So if you have a group policy that covers your parents, when you retire, you can convert that into a policy that covers your parents as well. And you imagine somebody is retiring at 58, 60, their parents are likely to be in the 80s, and the importance of health insurance at that age. It is a fundamental right, and many countries governments change on health insurance, and it is becoming increasingly important and electorally, even in elections it is becoming important in India, and going forward it is going to become even more important.
But then just focusing on the point where you mentioned that it will be very difficult for you to buy a health insurance, at that age, or maybe if you get one, you'll be having a waiting period for certain diseases. Talking about the kind of trend that we are seeing in health insurance and the kind of launches, the kind of products that general insurance companies are coming up with, are also in tune with this particular thought that maybe someone wants to buy health insurance when they are about to retire or when they have retired already. So not many, but then there are few products which are specifically aimed for senior citizens. Could you just draw out a structure of those kind of plans which are available, what kind of waiting period they have for what kind of critical illnesses, and most important, are these plans at this age expensive to buy?
So they would be expensive even if you bought them in advance. So so I don't think the cost will differ. But let us stick to these, quote unquote senior citizen plans, right? That you buy when you have become senior citizen. First, even availability of these senior citizen plans, if you will, and today having some heart problems, having blood pressure, having diabetes is pretty common by the time you reach 60. For them to get even these senior citizen plans is going to be very tough, no matter what the brochures say. That's one. Second, if you look deep into these plans, most of these plans have what are called co-pays, and they're not necessarily wrong, okay? Because for every 100 rupees, they would require that you pay X percentage, let's say 20%. There is a plan that says 50% you will have to pay yourself. So yes, it does give some coverage, but it is it is still tough to get. Plus, it gives only partial coverage. Plus, you will not get a large sum of money. So, for example, for all our clients, we make sure that our clients don't depend only on their employer insurance, even though that might be very generous. But we make sure that they also have fairly decent, and by decent I mean say 50 lakhs or a crore of health insurance, which will pay for hospitalization expenses, by the time they are 40, 50, even though that may not be used, because the premiums are reasonable at that age, plus you get a no claim history by the time you are of retiring age, and getting claims at that age is difficult. And remember, medical inflation is running in double digits, and therefore what 50 lakhs looks big today, in 7 years time that's going to be half. So 50 lakhs is equivalent to 25 lakhs of today's money 7 years hence. It's equal to 12 lakhs of today's money 14 years hence. And medical inflation is probably running at much more than 10%. The figures that I'm giving you are not astronomical. Unfortunately, health insurance premium is a good investment. And I say unfortunately, simply because you would be very fortunate if it is not a good investment for you, that because most people will, in their later years, will use up their health insurance amounts not once, but in over multiple years. So, unfortunately, health insurance is a good investment.
One more point where I want you to help our viewers understand or maybe stress upon, because we're talking about life after retirement and we are talking about the importance of having enough or the right kind of health coverage. Times are changing, you know, now dynamics in a family or the family structure is also changing. A lot of time parents don't have their kids around, kids are abroad or maybe not living with them. This is the time when you have to take care of your health, and obviously having the right kind of health insurance is needed. But apart from that, because we don't have that kind of a culture in India where there are healthcare facilities or communities which are starting up, but then it'll take a long time for them to become very common for everyone. How can one ensure if they are living alone, they are taken care of? This will definitely this has to be more than having a health insurance plan.
Oh, absolutely. I mean, health insurance will only pay for expenses, right? You
Exactly. Yeah.
hope to God it goes completely waste and that you don't have those expenses in the first place. And I think many research has shown that people who are more social, they have a friends, they have connections, whether those connections are family connections, whether those are friends, whether it is the the religious connections that they might have with the particular religion that they belong to. A lot of this research is Western, but it also some of it has been done in India as well. Very clearly, people who are socially well connected, equalizing for all other things, they live longer and they live healthier and longer. And I think that is a critical thing. And coming back to your question about, what kind of community and what kind of facility to live in. So one obviously is you live in a facility that will give you required medical facilities, but one must not forget that the big importance is also it must give you a community. For a lot of people in India, the community is already established. They are living in an area where their friends are there, their family is there, there are support systems that already exist. And for them to sort of shift to a completely different center, which for real estate cost purposes tends to be outside the main cities, tends to be more difficult for people who, because their children have gone overseas and their circle has somehow dwindled, uh, they may also look at these communities because then they will meet like-minded people, and that is as and more probably important than having health insurance or having medical facilities.
Last question to you, and this is the question that I ask you every time whenever we have a discussion on anything related to retirement: maintaining a constant flow of income. This is something that one needs to plan at an earlier stage, but what all needs to cut down in your daily expenses so that you maintain that constant flow and really don't go overboard, and also at the same time continue your investment strategy and just not get scared of equity. That is something that maybe you can have in your portfolio in a smaller amount, but then to beat inflation, that's the asset class one can bank on even after retirement.
So first, I think if you have planned well, then you ought not to cut down your expense. The whole idea is to live retired life fully. Okay, so if you have planned well, clearly you have not planned well if you have to cut down on your expenses. One. Second, one must remember that if you have planned, let's say, that you will probably live till 85 and you have planned your resources like that, keep on upping it. The science behind longevity and better health spans is expanding so fast. Every day there are new developments that you are probably going to live much longer than you expected, and hopefully you will also live much healthier. So at least financially you need to be prepared. In any case, retired lives are now 25, 30 years. That kind of a period, inflation can ravage your investment strategy if you have not prepared for it. And you have asked me this question many times. I'm going to give you the same answer. have equity and have it in a self-balancing form. Look at, and I think later on in the program, you're talking about equity saving program. What a lovely little product that is for a retired person to get equity or a little bit of equity, that too in a automatically self-balancing form. So whether equity saving, whether balanced funds, whether balanced advantage funds, I think look at equity because you are, God willing, going to live a long, long time and live it very, very healthily. So you need to plan for it.
Can one also try direct equity? Can one also have a portfolio of stocks?
So I would not advocate it. I mean, especially for people who have a lot of money, because in my opinion, lots of money and lots of time equals to disaster. And you have the SEBI report that tells you why it is a disaster.
All right, so these are the things that one needs to really keep in mind after retirement, and what's going to happen after retirement, at least financially, you need to plan right now. Thank you so much, Harsh, for being on the show and helping our viewers with that. And on that note, let's take a quick break, and post that, we are going to talk about a very interesting hybrid category where investors can invest and have a balanced approach towards their entire portfolio after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, among the various categories of hybrid funds, one of the very intelligent fund in terms of allocation logic is the equity savings fund. But what exactly are equity savings hybrid mutual fund, and what kind of investors should be looking to invest in them? Let's answer all of these questions with Aamar Deo Singh, Head Advisory, Angel One Limited. Aamar, good evening and welcome to the show. Thank you so much for joining in today with all your research on this very important hybrid category, equity savings fund, which have been in vogue for quite some time, especially when we talk about the hybrid category. It's an amazing product because, in fact, I would like to call it a very intelligent product because you have equity, debt, and cash futures in it. But then, in a layman's language, just for the sake of understanding, what kind of a portfolio mix an ideal equity savings fund would have?
Yeah. See, what happens here in this fund is that it more displays or plays out the risk profile of the investor, because that's something which is very important from an investing from a long-term perspective. So when we look at these equity saving hybrid funds, so they have a mix and match of different asset classes. So be it equities, be it bonds, be it gold, be it even holding a certain percentage of cash. So they basically look at allocation from a risk profile perspective. One. Secondly, we also see is that even in equities, you got some. Now, suppose someone wants has a low risk appetite, then for that person, a mix of debt with equity could make sense. So a large cap, again, he wants to take low risk. So large cap stocks could be looked at. So you've got a wide variety of options when you're looking at these funds. So you've got large cap, mid cap, small cap, you've got active funds, you've got passive funds, then you've got these multi-asset allocation which can happen. And the best part is that there is also something called a dynamic allocation which happens. So in some of these funds, wherein based on market conditions, so for example, if interest rates are moving up, then it makes sense to move into debt. So a significant chunk of the portfolio would then constitute debt as compared to equity. So a lot of this sort of intelligent investing comes into play when we are looking at this type of funds. And also what happens is that, for example, if someone is looking at a more, I would say, equity-oriented fund, so it could, the fund allocation towards equity could go up from 65 to 70%. In case the person or the investor isn't that much doesn't have that much of a risk appetite, then that could means come down to as low as 30-35%. More could be in the, I would say, a debt instrument. So this would be more conservative hybrid, and the other one was more aggressive hybrid. So you got a lot of options here, and the investors also have that I would say confidence, because this I would say different type of funds which is available here, it also has a decent track record to look up to.
Clearly, equity component offers growth and also appreciation of capital, Amar. But then let's talk about the arbitrage part of it, which could be slightly tricky for the investors to understand. It definitely constrains the upside, but then also mitigates your risk. How does that happen?
Yes, see, generally what happens in arbitrage is more of a price play difference, wherein the risk of a downside is to a very great extent minimized, wherein the upside, as you rightly said, that seems to be capped. So what happens in that case is the returns also, if you look at these arbitrage funds, they are not that great, I would say. But comparatively, some of them do beat the FD interest rates which are offered, but more or less it's more of a way of investing, and more or less it would be more suited for those who are having a fund of funds. So they are looking at, say for example, aggressive hybrid funds, and they could also be looking at some part investing in I would say arbitrage funds. So where the returns would be in, I would say, more or less in single digits, but again, that gives you an opportunity to diversify in case of extreme market conditions.
So, in a product like an equity savings fund, Amar, there are at least three asset classes through which you get the benefit of diversification, or there can be more.
Yeah, I would say there can be more as well. So
Okay.
it could be, suppose someone looks at a see hybrid here. What happens is that the percentages keep on changing. So you can change the percentages based on market conditions, which I said was dynamic allocation, which is possible in hybrid. Other way you can look at is balanced, wherein you are investing an X percentage in different asset classes. So it could be, for example, equities, then it could be bonds, it could be gold, because gold also being part of a portfolio makes a lot of sense if you look at the current returns which gold has generated. So it definitely helps having assets which are to a great extent, they are not means too much the positive correlation. So that way there is the diversification option also there, and also I would say that gives the opportunity to look at different asset classes. So what we find is that when the equities are not performing, we find that the debt funds are performing, we find that gold is also performing. So likewise, but what happens is when the equity starts performing and you don't have the bond markets or the debt instruments of gold not performing, so there is where the dynamic asset allocation happens. So that opportunity is also available in such type of hybrid funds. So one should look at that as well. And some, I would say, funds also look at holding in I would say cash to a certain extent in case they want to just wait wait it out. So that option is there. But primarily, I would say it's more of the equities, bonds, a different type of debt instruments, and bullion as well.
What are the top performing equity savings funds?
Yeah, amongst that, if you look at this top performing funds, I would say ICICI Prudential Equity Debt Fund that has generated annualized returns of over 28%. If you look at the last CAGR of the last 3 years, so that fund has been quite a good performer, and it has been aggressive on the I would say the equity side, but they are also have a significant chunk in the debt. Other equally good performing funds, I would say, during the same period, in the one is the HDFC Balance Advantage Fund that also has generated a annualized return of around 27%. Then Kotak Equity Hybrid Fund that also has generated 25% annualized return. So these are some of the funds which have, if you look at them, so they have performed reasonably well in this category.
Heavy on the equity side. I mean, they have an exposure towards equity more.
Yeah, but they also have a chunk invested in the debt as well.
Mm-hmm. Mm-hmm. What about multi-asset allocation fund if I want to compare them with these funds?
I would say multi-asset allocation funds, their returns would vary, and that is more of an active play. So there the returns would vary, because if some of the multi-asset funds have invested in gold for that matter, then they would outperform in that case. Otherwise, I would say the performance in these funds are comparatively better.
Uh, what kind of an active strategy you think a fund manager needs to adopt when we talk about the current market scenario, and considering that we have the benefit of equity and debt in this particular fund, it will definitely provide some kind of a relief for a conservative investor if there is more of a debt component in it. But then, do you think the fund manager has the flexibility of reducing or increasing either of the asset classes in the fund?
Yeah, see, generally what happens is that it's all market cycles which come in play. And if you look at the current trend of rising interest rates and also inflation catching up, so now we are seeing some sort of peaking out. But still, it's early to say that interest rates have peaked out, because still we have some way to go, at least a couple of quarters till we can confidently say that interest rates have peaked out in the US. That's one. So clearly shows that fund managers who are looking at actively managing their portfolio, because on one side you can have a pure equity portfolio, the other side you can have a mix of different asset classes, multi-asset class, including a component of gold. So there the opportunity lies greater in terms of managing, because there are two things one needs to remember. One is returns. We talk about returns, but we also need to understand what is the underlying risk, what is the sort of risk or the drawdown or that the funds are actually displaying over a period of time. So there the multi-asset funds would anytime outperform, and anytime they would perform better. So that's an option one should definitely look out. But that would be, I would say, a lookout of the fund manager as to when the switching happens, or in terms of what is the percentage one would look at investing in equities or bonds, or for that matter, gold. But having a healthy mix of these three, definitely, I would say from a long-term perspective, one gains, because one also needs to remember that when there are major up moves, we also see some major corrections. So if there a diversified portfolio helps you in minimizing the downside, that itself is a big plus. So there, multi-asset allocation definitely helps.
Amar, the kind of funds that you just mentioned, those are the categories that you mentioned. Now, specifically talking about the equity savings fund, I can see a long list of equity savings fund that are launched by AMCs. You know, you've got a Sundaram Equity Savings, you've got Axis Equity Saving Fund, Edelweiss Equity Saving, SBI, ICICI, HDFC. What is different in these funds than the one you just mentioned? Because the earlier what you mentioned was category. I'm talking specifically about these funds and the kind of return, minimum 3 years return, what has been the performance of these equity savings fund.
So generally what happens here is that if you look at this equity savings fund, they are more attuned towards equities. Now, again, what happens is that there you have three classes there, meaning you have the large cap, you have the mid cap, and the small cap. So large cap is more for those who are looking at decent returns. So the returns anywhere could vary between 12, 14, 15% sort of returns, because large caps anyways, they are big sized companies. Then you got the mid caps and the small caps. I would take them together in some say, because there's also something called the multi cap theme. So wherein you got a mix of large cap, mid cap, and the small cap. So here the returns could vary. So depending upon, because naturally when you look at small caps, it's more of a major upside, but at the same time a downside is also there. So in that case, what happens is that the returns could vary anywhere between, I would say, 15, 18%, could go up to as high as 28, 30% as well, depending upon the period one holds. So that would be the sort of returns. Ideally, one is looking at investing in mid cap, small caps, or multi I would say different caps, or a multi cap fund from an equities perspective.
Thank you so much for being on the show and helping our viewers with all the details on this fund category. On that note, we'll take a quick break. Post that, let's get your portfolio queries answered by Aditya Shah. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are a plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Aditya Shah, Chief Investment Officer, GST Investments. Also, do not forget to send your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. So, let's begin. Aditya, good evening and welcome to the show. We have Bhanu Pratap's question for you first, and he says that he's doing an SIP and he wants to achieve the corpus of 5 crores, and He is right now investing in Parag Parekh Flexi Cap. He has Quant Tax Plan, SBI Equity Hybrid, SBI Focused Equity. And he wants to understand which funds he can hold and from which fund he can make an exit strategy. Also, his time horizon is 20 to 25 years. And you need to help him understand if there has to be any increase in the SIP amount. So, first, what about the funds?
Ma'am, if the investor is wanting 5 crore rupees at the end of 20 years, if I assume that, and I also assume that 10% return is possible in a mutual fund, the investor must SIP at least 50,000 per month. The investor is not doing that right now. Considering the fact that the amount is much lower, there can be two options that the investor can choose. Point number one is elongate his time horizon to about 25 to 30 years, or he must increase his SIP. It is very, very difficult to nearly double the SIP amount in a short duration of time. So what he can really do is he can step up his SIP every year for by at least 10%. That's the first point that I wanted to make. Second point is the choice of funds is really okay. Parag Parekh Flexi Cap Fund, SBI Focused Fund, and Quant Tax Saver Fund is just look fine. No problem as such. You must increase the SIP amount in the SBI Equity Hybrid Fund, or he can move to a pure play small cap fund. Also, since his time horizon is about 20 years, so I will suggest a DSP Quant Fund if he wishes to substitute the SBI Focused Equity Fund. Otherwise, the portfolio looks okay, not a problem as such.
All right, so that will be all for Bhanu Pratap. But then we have our next viewer online, Krishna Teja from Hyderabad. Good evening, sir. How are you doing?
Yeah, I'm doing good. Thank you.
All right. Could you tell me the name of your funds that you've invested in?
Recently, I have started SIP of 4K in the ICICI Prudential Technology Fund. So, yeah, I'm aware of that. Now the IT stocks are under pressure. So, I would like to take some time at this point of time to take the risk to get the maximum return from this point. So, my time horizon is like 7 to 8 years. This is for my daughter's higher education. Okay. So I would like to take suggestion, as banking sector is also under pressure. So should I continue this SIP 4K in the IT sector, or can I split this to the IT and banking 2K on each? So it would be great if you can provide insights on this.
So you have a specific large cap fund, flexi cap fund?
Yeah, flexi cap means I have a tax saver fund. That is Canara Robeco tax saver fund. And I have Nippon India S&P Sensex fund. And one small cap is Quant Small Cap Fund.
All right.
These are for my long term, like retirement fund, like. But whatever the 4K, I'm started investing in the technology fund. This is for my daughter's higher education. So
okay. When you say you have added a technology fund, this is what, months back or years back?
No, I had only one SIP. I mean, I started last month itself.
Okay. So you are aware of the fact that you don't invest in mutual funds the way you invest in specific stocks?
Yes.
So whenever you are picking up a sector-oriented fund, you need to hold on to that fund for a particular period of time, which has to be more than 5 years at least. Yes. And you have to track the kind of movement the sector is specifically going through, which right now is not a very good scenario or a rosy picture when you talk about the IT sector. Okay. Similarly, when you're talking about banking, having a sectoral exposure is not wrong, but then you need to hold on to that particular sector for a longer period of time. It's been 4 months you've added ICICI Technology Fund. Aditya, Your take on this? He wants to hold this for 7 to 8 years.
As I have been repeatedly continuously saying, technology funds carry a sectoral risk, and sectoral funds are only for those who are highly risky individual investors. The investor must assess his risk profile and think if he wants to take on this amount of risk. That's the first point. Second point is technology is undergoing a severe downturn at this stage. We've already seen some of the US banks failing, and they are directly connected to the technology sector. So, in my view, at least the next 2 to 3 years will be very, very difficult for the technology sector. And from there on, the technology sector will do well. So, if you have a longer time horizon, only then please invest in the technology sector. ICICI Technology Fund is a good fund to invest in, so no problem as such. Invest there. However, have at least a time horizon, as you have written, of about 7 to 8 years, and don't get dissuaded by the near-term underperformance of the fund. Again, with the banking fund, we've seen that the banks have not really performed as stock prices for the last 1.5 to 2 years. And it's a great time to be loading up on the banking sector. However, again, they carry a sectoral risk, and you should only invest with a longer term time horizon and not a shorter term time horizon.
All right, that will be all for you. Before I move on to our next viewer, Aditya, who is Tuhin Sarkar from Kolkata, before I take his query, what would you like to tell our investor who plan a short-term play in sector funds, like the gentleman we just spoke to? They tend to time the momentum play and the way they do it in stocks. Why is it important to understand how a mutual fund functions, and especially a sector or a theme-oriented mutual fund?
Ma'am, what usually happens is sectoral funds go through up cycles and down cycles. What generally retail investors really do is when the sector does really well, they tend to invest in that stock, stock or in that sectoral fund, and then forget about it. And then there's a down cycle, and all of their gains are wiped out. So timing of entry and exit in a sectoral fund is really very important. That is something that one needs to really consider. Considering the fact that a retail investor must have a job and does not have the time to understand the entry and exit from these sectoral funds, it is a much better option to invest in a diversified fund where the fund manager takes the entry and exit call and you don't have to do anything. It is like telling a doctor when you go into a sectoral fund that treat me this way. If you don't have any specialization on how to treat a disease, leave it to the fund manager and the fund manager will decide. If you are a highly risky investor, then you can time the entry and exit into the sectoral funds. However, for 99% of the investors who are watching this show, I will not suggest them technology fund. Rather, try to invest in diversified flexi cap fund. If you have a longer term time horizon of about 15 to 20 years, then a small cap fund will also do for you. However, stay away from sectoral funds as during the down cycle, the drawdowns can be severe. We've seen some technology stocks fall as much as 10% yesterday, and there have been drawdowns in the technology funds. So, in my view, stay away from them. Only those who can tolerate the high amount of volatility and risk should go ahead and invest in those funds.
Right, we move on. We have Tuhin Sarkar from Kolkata on phone line with us. Hi, good evening, sir. How are you doing? Tuhin?
Yeah.
Hi, good evening.
Yeah.
Thank you so much for sending us your query. I think you want to know a mid-cap fund?
Yeah, I want to know a mid-cap fund. I'm already investing around 40,000 from through SIPs for 3 to 5 years.
What's the fund mix
I want
like
to
in
know
your
a
portfolio right now, Tuhin?
Pardon?
What is the fund mix like in your portfolio right now?
Well, I have flexi cap, I have large cap, I have small caps, I have focus fund, but I don't have a specific mid-cap fund in my portfolio.
Do you think you really need one because you have a flexi cap, you have a focused category as well?
I just wanted to know which is the ongoing best mid-cap fund right now. Mm-hmm. But I have these portfolios in my these funds in my portfolio right now.
And you are doing an SIP of 40,000 already in this mid-cap. You want to invest more?
40,000 in various schemes per month.
And I want a specific mid-cap fund, if possible.
So in 3 years' time could be very less for a mid-cap fund. Do you mind
I understand that. It can be the period can be between 3 to 5 years.
I would suggest more than 5 years, but then let's let Aditya answer this question. Aditya, first of all, do you think he really needs a mid-cap fund? He's been asking for a specific mid-cap, but then do you think his portfolio already diversified well enough?
Ma'am, you've hit the issue spot on. Point number one is there is absolutely no need for a mid-cap fund. Generally, what retail investors think is that they need to have one fund in small cap, mid-cap, flexi cap, large cap. There's no need to have so many funds. If you are already investing in 3 funds, I think for a 40,000 rupee SIP, it's more than enough. The first point. The second point is for any mid cap or a small cap exposure, 3 to 5 years is a very, very less amount of time given the volatility in the market. To invest in a small or a mid cap fund, at least 7 to 10 years is required. I will not suggest the investor to go ahead and invest in a mid cap fund. I will suggest to increase his SIP in a flexi cap fund that he's already investing in. However, since the investor is asking for one of the names of the fund, I will suggest the DSP mid cap fund. It is well run. It is well managed by the fund manager. That is one. But I will not want him to add this fund at this stage. Elongate your time horizon, and if you have 3 to 5 years of time horizon, stick to flexi cap funds.
And if at all, whenever you plan to add any mid-cap fund, in fact, he also has a small cap fund in his portfolio. So it's advisable if you hold it for 7 to 10 years. And whenever you add a mid-cap fund, have the same kind of time frame of 7 to 10 years. We have JS Rao on phone line with us from Hyderabad. Hello, Mr. Rao. Good evening. Thank you so much for sending us your query, sir. How are you doing today?
Yeah, actually, I wanted to know about the whether nomination is required or not.
Absolutely. Nomination is definitely required. But is that the only question?
Yeah, that's the only question.
You are withdrawing the funds in SWP. Okay.
Yeah.
All right. Aditya?
Ma'am, according to the regulators, latest circular, nomination will now be required across all mutual fund holdings, be it a single holding, be it a joint holding. So it does not really matter if you have a joint holding. You will have to go ahead and give a nominee. How you can go ahead and do that? You can write to the mutual fund company to have a nominee inside your folio, or you can visit the CAMS or the RV office where they will give you a form where you can fill up the nominee. Having a nominee is very, very important because in case something happens to the unit holders, the units can be transferred into the name of the nominee. So yes, nominees will be required, and you need to visit the mutual fund company or the service providers to mutual fund companies like CAMS and CARVI in order to get this nomination done.
All right, we move on, and next question is via email, SB Sivakumar from Madurai, and he says that he is 53 years old. Okay, I think we have him on phone line, Mr. Sivakumar. Hi, good evening, sir. How are you doing? All right, we move on and we'll just take his question. He says that he's 53 years old and he's working in a private sector, and he wants to understand that if he invests 10 lakh in a balance advantage fund, how much can he withdraw through SWP after 7 years? For that, we really wanted him on the phone line because we wanted to understand how much he would want after 7 years, which I think would be his post-retirement phase, and for that purpose, he's also investing. But a lot of calculation needs to be done. What could be the steps to help him get the calculation right and understand how much amount is needed for him?
See, ma'am, if he invests about 10 lakh rupees today, and if you take the time horizon of about 7 years, assuming a 10 to 12% return in a balance advantage fund is not bad, and then you will have anywhere between 25 to 30 lakhs inside the client's portfolio. That's the first point. Second point is, how do you withdraw this money? You can withdraw any amount of money you require. What you need to really specify is what is the time horizon of this SWP that you are really looking for.
I think we can get more clarity because we have Mr. Kumar on phone line with us. Good evening, sir. We are taking your question on the Money Show. Thank you so much for sending us your query. So we want to understand, after 7 years, what would be the amount that you would like to withdraw via SWP?
Yes. Yes, madam.
So what would be the amount?
What percentage I should withdraw? That is my query.
So that depends on your requirements, sir, because I believe this is your post-retirement phase, and you might want to have this amount at that time when you don't have an income right now. At that time, not right now. So, so how much would you need monthly?
I want to protect my 4 to 5%. I want to protect capital as well as the earn this amount.
Okay. Aditya, anything else you want to ask?
No, I do not get him. Can you repeat what he said?
I think his focus was on capital protection, what he is investing. Is that right, Mr. Kumar?
Yes, madam.
All right. So, Aditya, we don't have a clear figure. He wants to understand how much he'll be able to withdraw. So, maybe you could just give him a rough calculation and the minimum amount that can be withdrawn via SWP.
So, as I already said, he will have nearly about 25 lakhs in his account. Post 7 years, I have assumed a 12% return that he will get on the balance advantage fund. Then what he needs to do is he needs to understand what is the time horizon over which he wants to withdraw that money. If it is over a period of 4 to 5 years or 10 years, then he can withdraw anywhere between 20 to 40,000 rupees every month through the systematic withdrawal plan, and that money will come to his account. So the real input that he needs to look at is what is the time horizon that he's really looking for. The purchasing power of his money is already protected when he's invested in a mutual fund, and he can get about 10 to 12% returns. So that's not really a problem. The withdrawal horizon needs to be understood by the investor, and then he needs to move on from there.
All right. We move on to our last query of the day, which is from Praveen, and this is an email. His goal is to build wealth for retirement, and he can keep investing for next 15 years. Currently, he's investing 50,000 Parag Parikh FlexiCap, PGIM India FlexiCap, HDFC FlexiCap, Quant FlexiCap. He has only FlexiCaps in his portfolio, and he wants you to check the health of his portfolio, and he would like to have an aggressive strategy, and he's also investing 50,000 ICICI Nasdaq 100 fund. All right, so so for the purpose of diversification, okay, one can have more than one FlexiCap in their fund, Aditya, depending on the kind of bias the fund has. You know, it could be a large cap bias FlexiCap fund, or it could be a mid cap, small cap bias. When having 4 FlexiCap, how can one differentiate in the kind of FlexiCap they want to have? If at all, it has to be more than one FlexiCap category.
The first point is, so many FlexiCap funds is not really required inside his portfolio. Since he's an aggressive investor, he can diversify his investments. The criteria to identify the FlexiCap fund is that you need to look at the fund manager strategy. If he's following a large capish bias, or mid capish bias, or a small capish bias. That's the second point. Third point is, I have suggested 5 funds for him: Parag Parikh FlexiCap Fund, PGIM FlexiCap Fund, DSP Small Cap Fund, UKI Nifty Next 50 Index Fund, and ICICI Nasdaq 100. He can SIP his amount equally into all of these 5 funds, withdraw from the other 3 FlexiCap funds that he's already investing, and SIP that money into these 5 funds. So this is a strategy that he should be following. So many FlexiCap funds are not really required. Since his time horizon is also longer, he can go ahead and invest across the mid cap and the small cap space as well, and that will ensure that he gets a little bit of value.
I think that will be all. Thank you so much, Aditya, for being on the show and helping our viewers with the financial portfolio queries. And before I sign off, I'm going to leave you with our WhatsApp number and email ID, where we keep waiting for your queries, be it mutual fund, insurance, credit card, tax, or anything related to your investment. Just send us your query on our WhatsApp number and email ID. Thank you so much for watching. Goodbye.